We are heading into uncertain economic times, and the possibility of a global recession in 2025 is becoming more likely with every passing day. What's driving these fears, and more importantly, how can you prepare to navigate what could be one of the most challenging economic periods of our time? Let's dive into the signs, the stakes, and the strategies. First, let's talk about the key signals. Over the past year, central banks worldwide have aggressively raised interest rates to combat inflation. While these rate hikes were necessary to stabilize prices, they've had a cascading effect on borrowing costs for businesses and individuals. As credit tightens, spending slows, and growth contracts, laying the groundwork for a potential recession. Could we be witnessing the early stages of an economic storm? In addition to rising interest rates, the bond market is flashing warning signs. The yield curve, a trusted recession indicator, has been inverted for an extended period. Historically, an inverted yield curve, where short-term interest rates exceed long-term rates, has preceded nearly every U.S. recession in modern history. This inversion signals investor pessimism about near-term economic growth. But is this time different, or are we simply ignoring the inevitable? Corporate earnings are another critical factor. Many companies are already experiencing profit squeezes due to higher labor and input costs. When profits decline, businesses often respond with cost-cutting measures, including layoffs. This in turn reduces consumer spending power and deepens economic contraction. How many layoffs could we see before the domino effect takes hold? Geopolitical risks further complicate the picture. Tensions between major economies, disruptions in global supply chains, and rising energy prices have created an environment of heightened uncertainty. These challenges exacerbate existing economic fragilities and increase the likelihood of a synchronized global slowdown. Are we heading toward a tipping point where these factors converge? Adding to these risks is the consumer debt situation. Many households have stretched their finances thin, relying on credit to maintain their lifestyles. With interest rates climbing, the cost of servicing this debt is rising sharply. How long can consumers sustain this before defaults begin to spike? The housing market, too, is under pressure. Higher mortgage rates are pricing many buyers out of the market, slowing demand and cooling prices. For those who purchased homes at the peak of the market with adjustable-rate mortgages, the financial strain is increasing as rates reset higher. Could the housing sector become another trigger for economic contraction? So, what does this mean for you? First and foremost, preparation is key. For individuals, this means taking a hard look at your financial health. Start by building or bolstering an emergency fund. Ideally, you should aim to cover 3 to 6 months' worth of expenses. Having this cushion can provide peace of mind and financial flexibility during turbulent times. But what if the downturn lasts longer than anticipated? Next, consider your debt obligations. If you have high-interest debt, now is the time to prioritize paying it down. Rising interest rates mean that carrying balances on credit cards or other variable-rate loans will become increasingly expensive. Reducing your debt burden will free up resources and help you navigate potential income disruptions. Will you have the financial breathing room to stay afloat? Investors should also assess their portfolios. During recessions, riskier assets like stocks often underperform. While it's never advisable to panic sell, you might consider rebalancing your investments to include more defensive assets, such as bonds, dividend-paying stocks, or even cash reserves. Diversification is critical to weathering market volatility. But is your portfolio truly recession-proof? For businesses, the focus should be on resilience and adaptability. Review your cash flow projections and ensure you have adequate liquidity to sustain operations. Consider renegotiating supplier contracts or securing more favorable financing terms before credit markets tighten further. Additionally, investing in operational efficiency can help mitigate rising costs and preserve profit margins. Will your business be agile enough to survive? Another critical strategy for businesses is maintaining strong customer relationships. In a recession, consumer spending often contracts, making it essential to retain existing customers. Focus on delivering value and building loyalty through exceptional service, targeted promotions, or flexible payment options. Are you doing enough to stay indispensable to your customers? Governments and policymakers also have a crucial role to play in mitigating the impact of a recession. Fiscal stimulus measures, such as infrastructure spending or targeted tax relief, can help spur economic activity. Additionally, central banks may eventually pivot toward more accommodative monetary policies if inflation subsides and growth falters. But how quickly can governments react before the damage is done? While the outlook may appear daunting, it's important to remember that recessions are a normal part of the economic cycle. They present challenges, but also opportunities. Businesses that can adapt and innovate often emerge stronger. Likewise, individuals who take proactive steps to safeguard their finances can position themselves for long-term success. Could this recession be the reset you've been waiting for to rethink your strategies and investments? In conclusion, the growing risk of a recession in 2025 underscores the importance of preparation and adaptability. By staying informed, managing your financial resources wisely, and planning for potential disruptions, you can navigate these uncertain times with confidence. Economic cycles come and go, but with the right strategies, you can protect your financial well-being and even find opportunities amid the challenges. The question is, are you ready to act before it's too late? Thanks for watching. Subscribe, like, and comment for more videos.